Hello guys, welcome back to another video by mykayaplus. I'm JP and with me is Chunbeng. So I think time to time we'll come across some questions on new investors asking us what to actually look at when they actually chance upon a set of financial statements. So if you look through or you want to practice value investing, chances are you really need to understand how to read financial statements, and a set of them actually comes with 3 sets or 4 sets of documents, right? But we will only focus on 3. So namely, the first one will be the income statement, the P&L. The second one will be the balance sheet, and then the third one will be the cash flow statement. So, and each statement have a lot of information. So when you multiply it by 3, definitely you're going to go through a lot of information and a lot of data. And sometimes it can be a little bit overwhelming. So here are a little bit some key items that we think that we can actually pick from the mind of Warren Buffett, right? Like what to actually focus on when you actually go through a financial statement. So we find that what Warren Buffett actually focused on is quite similar to what we do. Hence, we come up with such a similar video to actually bring you guys through on what to actually focus on whenever you come across any set of financial statements. So of course, there will be real life companies mentioned. Of course, do not take it as a buy, sell, or hold decision. It's just mainly to exhibit an example on how to actually study and go through a financial statement. So without more than that, I'll pass it to Chunbeng, why we come across this video and what book actually inspired this video to be recorded.
Yeah, I think if you have time, I think this is one of the book that you can actually go after to actually give you some idea on what is the strategy or what is the thought process behind Warren Buffett. But of course, this books is actually named after Warren Buffett and called as Warren Buffett and the Interpretation of Financial Statements. But it's actually not written by him, but it's written by the other authors. But again, so I think this actually inspired us a lot when we actually go through the book, and of course, together with some of our own strategies. This is how we typically go through the 3 statement when you go inside the annual reports. So I think the first one is the income statement, or usually you call it as the profit and loss (P&L), and then we will be actually giving you an example from Apple Inc., which is a company that one of the favorite company by Warren Buffett. So like, when you actually look into this kind of companies, what is the key thing that Warren Buffett will actually look at when he actually zoom into the income statement? Of course, the first one, he wanted to know whether this company is actually able to draw a lot of sales. And of course, the sales figure will be translated into revenue. And then you're able to drawing revenues. Is it consistently having some sort of growth on a year-to-year basis? And if you can fast forward to a 5 or even 10 years, and this company are able to consistently give you the returns and consistently give you the growth, I think these are some of the criteria that you can straight away give it a pass. So secondly, you have all the revenue in hand, good number growing. The second things that typically Warren Buffett will look into is the gross margins. So what does gross margins mean is basically, think of it, you are a business owner, you actually manufacture some stuff, and to actually achieve a revenue of 1 million, just think of it, let's say your raw material is about 600,000, and then if you take this kind of simple calculation, your gross profit margins will be actually land at 40%, because 40% of it is actually the net off between revenue minus off the direct cost. So if a company is showing a very good number in gross margin, it also represents that this company is kind of matured and they have a lot of control against the raw material cost. So if you look into some of the mid to downstream company, they may not have the kind of advantage, and they may be competing at actually about 10 to 20% kind of gross margin, which is kind of difficult to actually give you the consistent return. And of course, the next thing to look into for income statement is to know whether this company is making money or not. So you can have impressive revenue number growing year on year, good gross margin, but then the company itself can be loss making. So if this company is loss making, then of course it's a no from Warren Buffett. He straight away actually take out this kind of company. So and then when you actually look into this kind of company, it's always true for more like a mature company, blue chip companies. Usually you can see it that way. But again, there are some of the other new company, they actually being labeled as growth stock. There's another angle to look into it. But of course, we can actually do some other videos to zoom into this kind of stock and what is the thing to take note if you wanted to analyze this kind of high growth company. And of course, now you have the three thing check. The fourth thing is actually what is the net profit margins. So how to calculate net profit is actually once you actually have revenue minus off the direct cost, you get the gross profit. After that, you need to minus off some of the sales and marketing expenses, R&D expenses, your staff costs, so on and so forth. After you minus off everything, then the thing that actually remaining is considered as net income. And then of course, you take the net income, divide against revenue, you get your net profit margins. So for example, if you're able to hit about more than 20% kind of number, it's actually kind of very good. You also represent this company can actually have a lot of pricing power. So very simple, a lot of number, but when you go into income statement, it's about whether this company have good revenue, is it growing, is it having a good margin. So then we can actually move on to the second thing, which is called the balance sheet. So what balance sheet means is basically give you a view of where the company position at, how much asset they are having, what is their liability, and what is their equity. From Warren Buffett point of view, it's actually kind of straightforward. The first thing you would look into when he actually check out the balance sheet is to check out the retained earning. So what retained earnings means is actually if you actually see the screenshot that we have in here from Apple Inc., the retained earning is actually a subset of the total equity. So the total equity is basically made of the initial capital that put in by the founder of the companies. And of course, along the year, if your company actually make money, and the money you didn't use it for something else like do some expansion for capex and so on and so forth, all the remaining will actually call as retained earning. So when they have the number here as positive and it also growing, means this company is generating more and more earning back to the investor like me and you. So it's very important to actually look into this kind of thing. Preferably, the number is actually growing year on year. But then, if you look into Apple Inc., you will see after 2017, the retained earnings actually dropped. So it is something that you should be worried or not. So this is another angle that you can actually look into this kind of company. So ever since 2017, Apple Inc. actually switched some of the strategies. So instead of use back all the profit and then let it inside the retained earning, they actually take the retained earnings to do some share buyback and also declare some of it as dividend. So in another way, they are using the money that they earn from their product and find a way to reward their investor. So this kind of thing is kind of interesting, even though it's not reflected in the balance sheet this row, but then it's another way to reward you. So if you see retained earning seems like something's wrong, actually you can have another way to look at it. So one of the good way to actually look at the company whether they're giving you a good return is to check out this ratio called return on equities. So you can see through all the different tactic that actually made by Apple, like for example, share buyback and so on, you can see their return on equity is actually growing, and it's kind of impressive from a number perspective. And from a very high level, view, what return on equity means is like when you put in 1,000 ringgit, what is the percentage you can get back from a return perspective or from a profit perspective? And other than that, some of the other things that actually Warren Buffett will focus on when he actually check out the balance sheet of each company is whether this company is having a very high number of debt. and if the debt is there, whether the debt is actually on a manageable level or not. So this is a few things that he will check on, even though there are so many things that you can, so many figures inside this balance sheet. This is a few things that he's focused on. And of course, the third one, which is another statement, which is called cash flow statement. It basically represents what is the cash movement within the companies. So usually it will be broken down into three things called the cash from operation, meaning from the operation standpoint, how much cash is being generated. And the second one is actually cash from investing. So investing can be from two angles. One of it is how much you actually spend to actually grow the company. So in this case, will be captured in the capital expenditure, for example. And also on the other hand, how much cash you manage to get from your investment in somewhere else. For example, you invest in some of other companies. Is it receiving some of the return from the other companies? The third one is actually cash from financing. It represents what is the number that you actually use to actually pay off your debt, or what is the number that's being recorded where you need to actually raise fund from elsewhere. It can be a debt from the bank. It can be issuing some bonds, so on and so forth. So this is a three thing that being stated in the cash flow statement. And then what to focus on when you look into this kind of statement is the first one. You can actually zoom into the capital expenditures, or we call it as capex. So in Warren Buffett mind, it's important that even though the company is actually growing, you shouldn't stop to find a way to expand your business. So capex is actually a good figure to represent whether this company is spending some of the earning in growing the company strategically. So capex can be a lot of things. You spend things to acquire a new machine. You spend things to actually do R&D, so on and so forth. So all these things is a figure that you should actually check on and try to compare it against the net income. And then you will get some sort of like a percentage. So in this case, Apple Inc. For the 2021 number is about 11.7%. You think, they earn so much money and then didn't spend a lot on the capex. Actually, it's okay because for a company that's already matured and big enough, they need to actually have a way to manage the whole expansion, or else you will see some of the high growth company, they actually have good retained earning, and then straight away they pump all the money back into capital expenditure, which can be very dangerous at the same time. So for a rule of thumb, a stable company that give consistent return, maybe a 20% kind of figure or 20% below is something that you should aim for. And then of course, the second thing is what I've covered in the balance sheet, sharing about the Apple Inc.'s tactics. So when you see the retained earnings actually dropping, you can actually cross-check the cash flow statement and check whether they actually put the money into somewhere else. For example, repurchase of common stocks. In this case, it's actually representing the share buyback, or they actually give out more dividends. So this is a few things that you can find out from cash flow statement perspective. And of course, to sum up all the things that actually focused by Warren Buffett is always about one keyword, which is consistency. So he's looking for a company that can consistently give you earnings, the company that actually giving earnings, consistently low debt, consistently having a good growth figure. For example, every year about 10 to 20% is a better one compared to another company that can have 100% growth on the year one, and then year two suddenly negative growth. So he are looking into this kind of consistent growth. And one example is something like Coca-Cola, Apple, is all the good company that actually give all these kind of characters. And of course, when you have all these tactics in place, the very ideal holding periods is actually forever, because the company will continue to perform. Everything is actually stable and nothing goes wrong. The best period to hold on is actually forever. But of course, there will be some time that you should actually sell off the stock, even though the stock that when you buy it is good. So probably I will actually pass it to Jupan to give some of the tips on what is the time that you should actually sell off the stocks.
Right. So I think when you practice value investing or growth investing, if you chance upon a company and you have spent all your time and effort to study it, and this company actually has, potential to keep on growing, and if growth in earnings and growth in potential tags along with the share price appreciation, of course, you want to hold on to the share forever, right? We don't want to make rash decisions going in and out, or just scalping for the sake of it. But there are times that you should actually sell a share. So, say for example, you are holding on to a company, the company as of now has slowed down, and you come across another company where the potential is much higher and you're also very confident of that company. So the first example straight off is actually to sell off the not so promising company, right, you have right now, and then pump the capital from that share to another share that is a better investment. So it can be various kind of examples, changing trends, disrupting technology, or better margins, or even better efficiencies when it comes to operating business. It can be a same company. It can be some companies coming from the same sector, same business environment, but just one company is operating their business at a far better efficiency. So that is one example that you should do. The other one would be a company that is losing competitive advantage. So to give you a straight example, back then previously, you have Kodak, a company that produces photo films. So whenever you want to take a photo, you need to insert this film into your camera, and then it will take photos, and then you exhaust the films, and then you need to send the films to get it processed. So there was a shift in technology and trend. When we migrated to digital camera, we do not no longer need the films anymore, and this was also the period where Kodak actually got affected very badly, because they were not the first movers in transforming how we take photos. And as of now, even still, no one takes or owns a digital camera anymore, because we have our smartphones to take photos. So this is one aspect you need to be also very aware of, what is actually changing. And last but not least, it would be to actually consider selling any upcoming disrupting technology stocks during a period of time where their valuation is at a premium. So back then, it was very easy to actually buy onto the hope and belief that Netflix will continue to grow as big as possible and become the only channel for people to stream on-demand videos. But fast forward to today, there are multiple competitors out there. Even the old players have suddenly shifted their strategy to also enter the video on-demand streaming. So easily right now you have HBO Plus, you have Disney Plus, and you also have Hulu. There are a lot of choices out there, and Netflix is not the only one player that is in the on-demand video streaming. So that is also one of the examples that you should actually sell off your company shares when the valuation is at premium kind of level. So I think that's about it. Hopefully, when you go through the facts and figures, whenever you come across the financial statements, you know what to focus on. But at the end of the day, financial analysis is just one portion of stock analysis. You need to also look at it from a business point of view, whether this business has the potential to grow and remain resilient and remain evergreen in whatever they do. We do not want to buy onto the next Kodak. You do not want to buy onto the next Netflix that gets disrupted so badly by their own competitors as well. So of course, if you're interested to learn more, we are more than happy to welcome you to our premium club, where we actually do these kind of similar exercises, look at figures, do a gauge and study on the business sector that a company is in, and then come up with our own findings and decision whether this company is worth to invest or not. You can check it out at the description, where we will actually be more than happy to welcome you to our premium club. And of course, if you like this video, you can actually give it a thumbs up, share it with your friends, families, and also do not forget to subscribe and turn on the notification bell button so that the next video when we release it, you're actually in time to actually catch it as soon as possible. So anything you want to add on, Jubing?
No, I think just feel free to actually ask us any question in the comment section. We will actually respond to it.
Yeah. So that's about it. We'll see you in the next video. Take care. Bye bye.